Greetings, everybody. This is Eric Cook. I'm with WSI Digital Marketing, and as you can see on your screen before you, you have joined the episode 11 of my banker education series, Fintech for Community Banks. Your fast follower strategy is riskier than you think. Appreciate everybody joining us live. For those of you who maybe found out about us through a social media link or through a referral, maybe from our speaker, just a real brief, Eric Cook, myself, former recovering banker, now digital marketer. We work with a lot of community banks and financial institutions around the country with digital marketing and social media and web development. So, of course, if there's any opportunities for us to help you in those areas, certainly let me know. But the guest of honor today is my good friend JP Nichols, and I am going to turn the screen over to him shortly, and we'll get started on today's presentation. Just a couple of housekeeping notes for everybody. We do like for webinars to be interactive, and if you've got questions or comments, would strongly encourage you to go ahead and use the chat functionality that's in your control panel, probably located on the right-hand side of your computer screen. So go ahead and type your questions in there, and when there's a break in the action, I'll go ahead and ask that for you. And today's session and all Banker Education Series sessions are recorded and made available at the Banker Education Series page. So you can see we've got episode 10 with the Bank 2.0 update that we had last month with Doug Johnson over at the ABA, legal and technology, social media issues with Deborah Gonzalez. So a lot of great resources that we're trying to put together here for our friends in the community banking space. So with that, I'm going to start the magic that is known as GoToWebinar screen sharing, and I'm going to send it over to JP and have him show his screen. And while he's doing that, just a real brief, I had the pleasure of actually hearing JP speak for the first time, and we got to hang out quite a bit at a WIB conference in Arizona a couple years ago, and was certainly intrigued by his topic, being a former banker myself, and somebody that loves technology and innovation and kind of where things are headed. I think I could have sat and listened to him for the entire day and was kind of bummed out he only had a 1-hour session. But he's got his fingers in a lot of different pots as it relates to innovation and technology in the world of banking and finance. And so without further ado, JP Nichols, it is my great pleasure to welcome you to episode 11 of my Banker Education Series. Thanks so much for joining us.
Well, great, Eric, and thank you for having me here. I'm fighting off a little bit of a cold. I'll try not to sniffle and snort too much, and I hope you'll forgive me if I do. But as Eric and I talked about this and talked about what's happening in this space and how can we keep bankers apprised of some of the changes and so on that are happening in our industry, it causes me to think, as it often does, of Clayton Christensen's 1997 book, The Innovator's Dilemma. And the core of that dilemma is exactly this. Why should I take good money and invest it in things that are new and unproven when I have real customers today buying real products that are paying off this quarter, this year, and why would I take any of that away and invest in something else? And this term has come up a lot. This is probably the book where most of us learn the word disruption from, whether we know it or not. And there's a lot happening in the space, and I often joke that as a part of Dodd-Frank, it's now law if you say the word bank and innovation in the same sentence, you have to cite Christensen's book, and I'm happy to report that I'm actually in full compliance. I wrote about this over 3 years ago now in American Banker, thinking about how do we maintain the business that we've been in for a long time and yet embrace the future and figure out how to bring new ideas to life. Well, in the book, Christensen talks about the steel industry. Prior to the 1970s, there was only one way to make steel. It was a very expensive process. It cost over $1 billion to build an integrated steel manufacturing plant. Then new technology emerged from Asia, the ability to make steel for 1/10 the cost, called mini mill technology. So 1/10 the cost of an integrated steel manufacturing plant, but there was only one catch. Mini mills could only make rebar. That's the lowest form of steel on the food chain. It's the cheap stuff that's buried inside the concrete beneath your floor and maybe inside your walls. But with that cost advantage, the mini mills eventually worked upmarket. They took on rods and bars and structural steel, and eventually the only thing left was flat rolled steel. Flat rolled steel is the highest margin, top of the food chain for the steel business. And prior to this, starting with the rebar, the steel industry actually thought it was great news that this new technology had emerged, because what that meant was they were giving up their low margin commodity product to somebody else. They said, great, take that off of our hands. We would much rather work on higher margin things like flat rolled steel. But eventually they figured that out too. And with a 90% cost advantage, it's not hard to see why. They had a lot of money to reinvest in R&D and develop new techniques. And pretty soon, flat rolled steel was made through mini mills. And today, virtually all the steel in the world is made through a mini mill process. And I don't have to tell you the kind of pain that the steel industry went through. The layoffs and the bankruptcies and the restructurings and the mergers that happen in the steel industry. And I start with this story because as I think about fintech and banking, folks, we're just in the rebar stage. So the things that are happening, most of the companies we're going to talk about today didn't even exist before 2008. When we were dealing with a global financial crisis and in the years since then, dealing with re-regulation and doubling down on all the things that we've been doing for hundreds of years, whole new classes of competitors have emerged around us. So fintech is hot. In 2014, over $12 billion of capital was invested in fintech. That was triple the year before. I haven't seen anybody tally up the 2015 numbers yet, but everyone expects it to be a firm rise again. So we've got well over $25 billion invested in the last few years in fintech. So the area is hot, while the industry is not. As we think about the banking industry, and we look at their innovation maturity level, meaning the level of activity dedicated towards innovating and finding new products and new services, the most innovative companies, the leaders, are doing things inside out and outside in, top down and bottom up. They're making investments, they're investing in incubators and accelerators, and there are very few of those banks, a small number of leaders with a high degree of innovation maturity. Small but growing group in the middle we call the learners. These are the folks who know they need to innovate. They've got pockets of innovation going on in their organization, but they're suboptimal. They really need to improve the effectiveness of what they're doing. And unfortunately, there's still a very long tail of laggards. And these are folks that still either willfully don't get it and choose not to, or just plain ignorant and don't see the things that are happening around them. So what happens if our maps don't match the landscape? This is a map from 65, not 1965, 65 AD. It's an actual map. And I've used this map on 3 continents already. And I usually start by asking the crowd, well, how accurate is this map? And my folks in Italy tell me it actually looked just fine to them. It is a decidedly Roman map. It's a decidedly European-centric map. And for hundreds of years, I suppose it worked at some geopolitical level of at least describing we versus they. But it probably wasn't very handy in terms of navigation unless you were just navigating up and down and around the Italian coast. But maps would continue to evolve as cartographers would sail along coastlines and map out, and the land masses would get more and more accurate over the coming centuries. But as late as the 1500s, the Renaissance period, we still had a worldview that looked something like this. Maybe the land masses looked a little bit more familiar, more accurate to what we know them to be today, but they shared a common trait, and that is all these land masses were surrounded by water, after which there was an edge, beyond which nothing existed, or the unknown at least. So imagine explorers setting sail from some European capital well funded by the Queen, these entrepreneurs of their day, known as explorers or traders back then. And the lead explorer is in the lead ship with the best crew, gets first out of port in the morning with a stiff morning breeze. The other two ships follow closely behind, but the first ship has a lead, and it extends that lead because it got out first and because it has the best ship and the best crew. And the second two ships notice that as the day wears on, they can't see the whole ship anymore, just the sails, and eventually just the tip of the mast, and eventually nothing at all. Well, what do the folks on those other two ships think happened? Well, they think he sailed off the edge, right? So what do you imagine their response to be? Well, I think in most cases we imagine that they turn around and head back to port, back to the safety of the known, and chastising their leader for heading off into that abyss, the great unknown. I told you we shouldn't have done that. You head off to the edge, and now you've sailed off the edge. Oh, woe is you. Well, meanwhile, of course, we now know better. There was no edge. They sailed off to explore new lands and create new trade routes. It would be another 450 years before we really got this picture of what Earth really looks like. First with unmanned spacecraft and eventually with manned spacecraft, but we had to leave Earth's atmosphere to really take a look back and understand what the Earth looks like. And the purpose of this is, if this is the map that we're using to navigate the banking landscape today, how accurate is it really? If we think the borders and the edges are defined by other banks, our peer group maybe, is that really the current landscape? Because I don't think it is. What's happened in the last 5 to 8 years have been a whole bunch of electronic competitors that didn't exist before. I often go through Porter's 5 forces to think about the banking industry. And the thing that's really new is a threat of substitution. We didn't have that before. If you didn't like my service and the way I did things, you could go to a competitor, but you were pretty much going to do the same thing in the same way that I did. So there are now substitutes for bank accounts and bank relationships. I can download a bank account. And those are just the direct competitors. You think about what's happening on the edge. We would never have thought of Amazon, the world's biggest bookstore, as being a competitor, but they provide their own payment services now. The ability to say, hey, I trust Amazon with my payment information, and I trust them to deliver whatever it is that I want within sometimes hours now, or certainly within days. The ability to put pay with Amazon on a website allows me to leverage that trust, and suddenly Amazon is a payments company, as is Apple in the upper right-hand corner, Apple Pay, along with Samsung Pay and Android Pay. This device that we carry with us everywhere is a trusted device that also has our payment information in it. Why can't we use it to transact business? In the lower right-hand corner, some screenshots from the Starbucks mobile app. The most successful mobile commerce app of its kind anywhere comes from a coffee shop. Right? A bank didn't invent this. A credit card company didn't invent this. They've got over $1 billion in free cash sitting at Starbucks because people trust the app, use the app, and keep prepaid balances on it. And the last example in the lower left-hand corner is Uber. I imagine most of you have used Uber. When I'm in a live audience, I usually ask for a show of hands, and this one has definitely reached the tipping point. People love using Uber. And think about how it's disrupted the taxi industry. I'll actually show you in just a couple of minutes how it's disrupted the industry. But think about the payment experience. What's the best part about the Uber payment experience? Well, for me, the best part is there isn't one. I don't want a payment experience. I want to ride from point A to point B. Same thing at Starbucks. I don't want a payment experience. I want my iced venti, no classic black tea without friction. So these companies have removed the friction from the domain that used to be solely ours, and it's not anymore. So what we have now is this whole new landscape, and I think most of us are still using pretty outdated maps to think about how to navigate it and how to manage in this world. So where do these ideas come from? Let's take a look at a couple of companies. Ikram Magnon Ismail and Andrew Cortina were roommates at Penn. In 2009, after they finished, they wanted to start a business together, and they weren't really sure what they wanted to do. But they knew from spending a weekend together, looking at different business ideas, and had some taxi fare and some lunches and dinners and so on, they wanted to pay one another back, and there wasn't really a good way to do that. They didn't want to wire transfer. There wasn't really, they didn't want to write a paper check for the other person to take and deposit into their account. There wasn't really a good peer-to-peer payment mechanism available in 2009, so they created one and called it Venmo. And Venmo really took off, particularly amongst the millennial generation. In 2012, Braintree bought the company for $26 million, and the very next year, PayPal bought Braintree for $800 million. By the middle of the next year, $1.6 billion of transactions was being processed on Venmo through PayPal, and by the next year that had grown to over $2.1 billion. Still a fraction of the $50 or $60 billion a year that PayPal is doing, but think about how PayPal saw this opportunity and saw a way to fill the gaps from their services to something their customers would want, and acquired Venmo to fit into that. Think about how these two guys, just college roommates a few years prior, built a business now worth hundreds of millions of dollars and transacting billions of dollars of transactions. If you look all the way back to 1976, Charles Schwab was a newcomer then. He had the strange idea that instead of expensive brokers with red ties and suspenders and expensive offices, that people might be willing to phone up and do discount trades if they had their own ideas of the kind of investments they wanted to make. And the idea grew a little slowly at first, and eventually it picked up. And in just 5.5 years, they had over $1 billion in assets under management. Well, fast forward to today, Charles Schwab has over $2.5 trillion of assets under management. It's clearly a well-established player, and upstarts are continuing to come up in this space. One of the best known is Wealthfront. Wealthfront is a so-called robo-advisors. So they didn't just replace the offices and the human brokers with telephones. They've actually replaced the brokers with algorithms, with robots, if you will. The ability to say, well, if you're this kind of investor, we think these kinds of investments will suit you, given the goals that you shared with us and the risk tolerance you've described to us. And here, we'll just put you right into it. So it's a very low-cost operation. Last I heard, I think they have about 40 employees, and in 2.5 years, they reached $1 billion. And, in the next year, they just doubled that again. They're now managing over $2 billion. And famously, if you think about the great quote that describes Wayne Gretzky, he skated not to where the puck was, but to where the puck was going. Look at who the top 5 employers of Wealthfront customers are. It's PayPal, it's eBay, it's Facebook, it's Twitter, it's LinkedIn. So those dynastic families that many of us have banked in our hometown because they've got their names on a factory downtown or an office building or something, those new sources of wealth certainly aren't coming to the local bank. They're being invested more and more through some sort of robo-advisor. There's another company called Betterment that's actually even growing a little faster than Wealthfront. But I think Wealthfront is a very interesting story when you look at how not only how fast they have grown, but where they're heading from here. Well, maybe you're not in the wealth management business, and maybe you're not in the peer-to-peer payments business, so those aren't all that interesting to you, and they don't necessarily feel all that threatening. But how about loans? Anybody here in the business of gathering deposits and marking them up and making loans? I suspect everybody. If you're in the banking business, that's really the core of what we do. And look at Lending Club. Now almost $16 billion of loans issued as of the end of last year. They did $2.6 billion just in the last quarter. So if you look at the chart on top, so $16 billion total, well, they did almost half of that just in the last year. So this is a company I've been talking about since at least 2012, and they really weren't much to write home about then. Did in 2012 less than $1 billion, worth of loan originations. And I think most of my banker friends thought, well, that's an interesting niche player. Sounds a little bit like Rebar to me. Meanwhile, they're working their way right up the food chain, and they're doing some serious volume. $1 billion here, $1 billion there. Pretty soon we're talking real money. Well, anything else besides loans? Well, yeah, really everything else. Every single line of business that we're in today, every single line on your income statement, on your balance sheet, now has one or more, probably several, competitors, non-bank competitors, asymmetric competitors, who are approaching this with a much better view on what the customer wants and how to provide a better customer experience, which we'll talk about in a few minutes, but also a much lower cost structure than most of us have today. You know, this is really going to impact us. Again, I argue we're just in the rebar stage. Most of these things haven't impacted us a lot, but I think over time it will. It's probably going to be a pretty big number. Well, there's a big number, $4.7 trillion. That's what Goldman Sachs thinks it will impact the banking industry on an annual basis in profits. $4.7 trillion is the threat of fintech. And yet, many executives still don't even know about these companies. This was a survey done in the UK, but based on my work in the US and elsewhere in the world, I think it holds pretty well. We could replace maybe some of the names. There's Betterment that I mentioned to you before. There's Venmo. 78% of senior executives surveyed had never even heard of the company that does a couple of $1 billion in transactions a year. Almost half had never heard of Lending Club, a business in the business of making loans, the primary thing that most banks generate their income from. Now, everybody had heard of PayPal by this point, but there's still a lot of ignorance about the companies here. And I could go on and talk about another dozen or two or 10 dozen different companies, but that's not really the point. It's how do we think about this internally? In 2010, Blockbuster thought they were pretty well positioned. We're strategically better positioned than almost anybody out there. Never in my wildest dreams would I have aimed this high, said their head of digital strategy in 2010. And we all know what happened with that. It was all going pretty well until it wasn't. And Netflix completely upended the business model for them. I talked about Uber earlier. Here's the impact of Uber in San Francisco. The yellow cab company files bankruptcy. Can you imagine this? The taxi company in a major American city has to file for bankruptcy because supply is rampant and demand has collapsed. The more people use their smartphone to get a ride from point A to point B. So think about how this impacts us as an industry. Well, here's the good news. Banking will survive. I cannot picture a time in my lifetime or my daughter's lifetime that we won't have banking, certainly. I can't even imagine a time where we won't have banks. But that's not the real question. The real question is, will your bank survive? I mean, what strategies do you have to undertake to make sure you're going to survive this era of digital disruption? And will your fast follower strategy really work? Because I think it's riskier than you think it is. Or will you face your own Kodak moment? Now, Kodak is famous for being a dominant global company that suddenly was irrelevant and eventually filed for bankruptcy. But what most people don't realize is it's not that Kodak was unaware of digital photography. In fact, it's just the opposite. They were pioneers in digital photography. They hired digital photography experts. But they couldn't shift the business model. They couldn't shift the attention of management and the spending and the budgeting fast enough to catch up to the wave. So this is why the fast follower strategy is riskier than you think. So how can we avoid our Kodak moment? Well, clearly, there is a digital threat. McKinsey breaks it down to an impact in the retail bank. They've said 20 to 40%, and they've come up with a chart here that says 35%. 13% of that risk comes from an innovative new offers that are coming from competitors, 16% more indirect, and that's how all of these alternatives will impact your margins as the customer expectations on the way they want to receive service and what we're going to have to spend to be able to get there, and another 6% on increased operational risk. But there's a flip side of it, there is also opportunity. That opportunity actually exceeds the risk, the ability to increase revenue from innovative new offers and business models from ourselves, being able to generate new products, distinctive digital sales, and using our data to cross-sell. And one thing we still have over fintechs is we have customers. It's very hard for these fintechs to scale up if they're going direct to consumer. And we have a lot of data about our customers. We know how much money they have, how much money they owe, what comes in, what goes out, when it goes, where it goes, and the ability to leverage that data to provide the next best product and to really improve the customer experience, I think is immense. McKinsey says it's 10%. I would guess it's greater than that. And finally, the opportunity to further lower our operational costs by leveraging technology, and we'll talk about that. So I think that any bank that wants to avoid the Kodak moment and really embrace the opportunities that present themselves in this era of digital disruption have to answer three key questions. And the first one is, what makes you stand out? When I do this in live audiences, I literally ask people, and I'll ask you now. I won't hear your answer, but we'll put you on the honor system. If I were to ask you, what one thing makes you different from all the competitors? We talked about this before. We all kind of look alike and sound alike and have the same products and same services. What makes you stand out? If you're anything like the audiences I normally work with, this is probably the word you said, service. And I don't think that means what you think it means. We tend to define service from our standpoint, and it means we've got really nice people. Our tellers smile really broadly. We say, thank you, sir, and we use your first name and all those kinds of things. And that's not really what our customers are defining as service. So let's dig a little deeper. In 1995, Michael Tracy and Fred Riersma wrote a great book called The Discipline of Market Leaders. And what they said was, there are three primary domains of any business, and you can only really, truly be a master of just one of them: customer intimacy, product leadership, or operational excellence. 4 years later, John Hagel and Mark Singer at Harvard came up with a pretty similar conclusion, although they used slightly different labels. They called it customer relationship management, product innovation, or infrastructure management. And I'm going to argue that very, very few banks, probably a handful globally, will truly be leaders in product innovation going forward. Very few are today, and very few will be going forward. So the question becomes, what's our future look like? Are we going to be excellent infrastructure managers, or are we going to be excellent at customer relationship management? This kind of answers the service question we talked about a moment ago. And I think it is customer relationship management. I think that's what our future looks like. But I think we have to be honest about whether we're doing that already or not, because if you look at the definition of each of those strategies, and for customer relationship management, it's highly service-oriented and a customer comes first mentality. I know we think we do that, but if we ask our customers, we probably don't really. And I think if we're really honest, we look at infrastructure management. This is really how we've managed the business, certainly for the last 50 years. Cost-focused, stress standardization, predictability, and efficiency. So we've done what's good for us and what's good for our shareholders, but in the future, we're going to have to really do what's good for our customers and really be relevant to them, and that means closing the customer experience gap. That's the gap between what they expect and what they're actually receiving. So think of your customers today spending all weekend watching whatever they want on Netflix, browsing Amazon on their smartphone and getting things ordered that arrive sometimes later that same day, and then walking into your branch on Monday morning, or worse, trying to contact your bank via the internet on Sunday at 10 p.m. because that's when it was convenient for them, and finding out that they have to come into the branch on Monday morning and sign some papers. Well, my friends at Claro Partners took a look at this and really discovered 5 elements, and they were focused on the millennials, but I don't want to get hung up on that. First of all, as you'll see in a few minutes, this stuff goes much deeper than a certain age group. And secondly, The millennials are older than we think, right? The oldest millennials are in their mid-30s now. They're some of our mid and senior leadership. The youngest ones are at least off to college and about ready to enter the workforce, at least on a part-time basis. So these aren't kids anymore. Secondly, it's a huge group. It's almost 80 million people. And as we'll see, that these trends are really impacting all of society, not just the millennials. But this study, always in beta, was done around the millennials, and they said really in these 5 areas is where things are really different between what they're expecting and what we provide. You know, from trust as an authoritative kind of thing. You should trust us because, you know, we're this big bank and we've got these great marble columns in front of us. Engagement means you're loyal to us and you do a lot of business with us over a long period of time. Planning means, well, the act of planning, that we actually sit down with you and create a plan, and that sounds like a really good idea from our perspective, but that's not really what they want. Financial management to us tends to mean delegation. Here, let us do that for you. And communication usually means we're going to provide you with a bunch of information. But their expectation is much more of a shared model around trust. Engagement through relevance. Planning through preparation, not just going through the motions. Financial management to them is enablement, not delegation. And maybe most important, communication is really about meaning and context, not just a brain dump of a lot of information. So how should we think about this and how should we manage this? Well, there's a great model from David Maister who uses a hospital to think through any service business. And if you think about this and think about the bank through this model, we start with the pharmacy. Pharmacy is a very standardized process and a very low-touch business model. We're successful in managing the pharmacy in our hospital when we have 50 pills of 200 milligrams each, nothing more, nothing less. It's all about efficiency and accuracy. As we move up to nursing, though, even though we're following very standard protocols, high touch becomes much more important. The bedside manner is a big determinant of success in nursing. And along this domain, this is really about execution. In the lower right-hand quadrant is brain surgery. It's highly specialized, but it's low touch. At least if we do it right, our patients are knocked out. And that leaves psychotherapy, both highly specialized and also very high touch. So the key to success here is really about diagnosis. And if we were running a hospital, we would see that as we move from bottom to top and left to right, our ability to earn fees go up, but our ability to scale the business goes down. So to translate this into the banking world, we can think about some of the products and the services that we offer and how they fit into each one of these quadrants. And all too often, we manage them all in kind of the same way. We should also think about, where does technology play a role in the way that we manage these domains? Because for the most part, we leave it here, right? Our equivalent of the pharmacy. We use technology for our back office processing, for item processing and transactions, things like ATMs, right? Very low touch, standardized process. But technology has advanced so much, especially in the last decade or so, and the ability to do both more specialized tasks and more high-touch kind of execution through things like artificial intelligence and machine learning, data analytics, it becomes more important than ever that we focus on diagnosis. That 50 minutes on the couch with each patient to understand what makes them tick, where their pain points are, and how we can solve that. And increasingly, technology is converging on that domain too. So we're often mismatched. We're really thinking about technology as transactions, and we think about managing the bank and the bank relationships with our customers through transactions, when what we really should be thinking about is the relationship and the customer experience that we provide in that relationship. The third question we have to answer is, how can we create a culture that embraces new ideas? This is something we're not really good at in this industry. When you think about the typical bank business cycle, if you adjust for interest rates and economic cycles, because those are the things that really cause variability of earnings in our industry. If you adjust for that, Our business cycle looks something like this. It's fairly flattish, low single-digit growth without a lot of variability into it. At least historically it has. And part of this has to do with what I mentioned earlier, is that there really was no threat of substitution. Well, most business cycles go through an S-curve, a slower period of launch, a steeper period of growth, and then ultimately decline. And there was a great book written in 2011 by Paul Nunez and Tim Breen that called Jumping the S-Curve. They said really the key to staying successful is being able to catch that next wave, jumping to that next S-curve before your whole business declines past the point that you can't recover it anymore. And the stuff that happens in between is this stuff called innovation. And for many of us in the banking industry, that's a scary word. It sounds risky, it sounds like stuff the regulator's going to hate, and it sounds optional. Nobody's making us do it today. We can get around to that next week or next month or next year, or even better, after I retire. But if we're going to jump the S-curve, we've got to really think about some new ideas and new ways of adapting things. But what ideas? Is this the idea that changes everything, or is it just a fad? How do I know? You know, I'm a child of the 60s, so I was promised a jetpack. I was supposed to live in a house that looks like the Space Needle. In the 80s, it was downgraded to a hoverboard and a flying car, but we've got none of those things. And how do I know which ideas I should be paying attention to and which ones are going to flame out? Well, I like to quote Bill Gates on this. He says, we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. So don't let yourself be lulled into inaction. Well, Gartner gave us a useful tool to visualize this. They call it the hype curve. And Gartner says, look, there's a technology trigger, and people get really excited about it. And sometimes that excitement gets well beyond reality, and they call that the peak of inflated expectations. We're about there in blockchain. Right now, blockchain has a new technology, distributed ledger technology, that supposedly will solve all ills of the banking industry. But eventually it will kind of fall down through the trough of disillusionment, and some ideas just kind of die there. They never really get realized. They rise and fall through a peak of inflated expectations, down through the trough of illusionment. But most ideas catch hold at some point, and maybe they get iterated on, maybe they were before their time, maybe they didn't have all the right pieces to make them work. And the ideas begin to climb the slope of enlightenment and ultimately the plateau of productivity. And one of the reasons that ideas take this kind of curve is because ideas don't happen in a vacuum. They happen amongst human beings. And Everett Rogers plotted this curve in 1957. Interestingly enough, it was not high tech at the time. He was looking at the way farmers use new kinds of seed, new kinds of crops and new seeds. But there is a fairly predictable pattern. Some of us are way out front on the cutting edge, innovators. And then after that come the early adopters who see the things the innovators work on and want to be among the first to do that. Eventually, it gets the bulk of us, the early majority and the late majority, where combined more than 2/3 of us live, and then eventually the laggards. So it's a standard bell curve, and for whatever reason, Rogers didn't draw out the second standard deviation on the right-hand side, but I can assure you it does exist. I like to think of this curve as the domain of my mother-in-law. She's the woman who once told me she didn't like to go to the ATM because you could only do it in $10 increments. I didn't know what she meant at first, but eventually I figured out she was putting in her card, punching in her PIN code, taking out a $10 bill, getting the receipt, receiving her card, and putting it back in 10 times if she wanted $100. So very different from my mother, who they're roughly the same age. My mom's a little younger than my mother-in-law, but my favorite text from her iPhone 6 is, do you know if Skype takes PayPal? I need a new headset. In 1993, Jeffrey Moore added an element to this and said, you know, that gap between the early adopters and the early majority is not just a gap, it's really a chasm. He wrote a great book called Crossing the Chasm. The focus of the book is for Fintech, or not necessarily Fintech, but technology entrepreneurs who want to cross the chasm. But I think it's really useful for us to think about it from the bank side, and it's most useful when we plot the curves together. And we see that ideas that drop down through the chasm tend to die off, and ideas that get traction have crossed the chasm, and that means that the early majority and the late majority are starting to get in on these ideas, and this is how ideas begin to take off. And the problem with our fast follower strategy is most of us in this industry tend to live way on the right-hand side of the curve. So we want to catch ideas much later. We've actually coined a phrase for this phenomenon. We call them trailblazers and traditionalists. So the trailblazers are the innovators and the early adopters, and they want to explore the unknown and establish next practices, while traditionalists want to master the known knowns and focus on best practices. There's nothing inherently right or wrong with either of these groups, and we can see even within the two broad archetypes, we've got a total of 6 different types of people that are at work today inside your organization. But the most innovative organizations in the world have figured out how to harness both groups. We wouldn't want a bank full of trailblazers. We'd be out of business in about a year because they would launch all kinds of big new ideas, bet the farm on the risk, and we'd be out of business. And instead, what we've had is, for the most part, up until the last 10 years at least, we've been managed almost exclusively by traditionalists, focusing on the known knowns and best practices. And the danger, again, is if we wait too long, it's too late. We can't catch that S-curve, and we can't reinvent our focus and our managerial attention and our budgets to catch that next wave, and that's why we run the danger of facing our own Kodak moment. At worst, traditionalists become the business prevention department. That's where ideas go to die. Don't worry, boss, somebody came in here with a new idea, but they won't be back. There's a very good reason why we're risk averse, right? We make loan decisions that on average need to be right about 99% of the time. That's exactly the right way to run the loan book. It's probably not a great way to run the entire enterprise. And I think we sometimes don't see the difference. Here's another way of looking at it. So let's look at how adoption affects that S-curve. So that business cycle, by the time you catch the early majority and the late majority and the laggards, and yes, even eventually my mother-in-law, for those ideas, you've reached all of the adopters. I mean, how many more new customers are we going to reach with our DDA account? Now, I know we have the unbanked and the underbanked, and we've got new people entering the workforce, but that's why we have single-digit flat growth outside of a traditional business cycle, and why these kind of S-curves and business cycles are really impacting us now, because if we're not relevant to an increasing number of people, a growing number of people, we become the opposite, which is irrelevant, and we begin to follow that S-curve, and eventually business begins to die off. Let's take a real live example. That was all pretty theoretical and sounded very much like the stuff I work through in the class I teach at the Pacific Coast Banking School. Well, let's look at smartphone penetration. Just in the last 4 years, we've gone from 43% penetration of mobile phones now to 76% nearly. Well, that sounds like it might be a real thing now. I don't think that's a fad anymore. I think that's something we might want to pay attention to. Well, how has this impacted our business? We look through, let's go back even a couple of years longer, look in the last 5 years, and the percentage of our customers, on average, who are interacting with a branch versus interacting with mobile have crossed for the first time. In 2015 was the first year we had more customers using mobile banking than branch banking on an average weekly basis. And yet, you look at the impact of this, we have 1 in 10 U.S. adults tried mobile banking for the first time. So we still have people just beginning to adopt this. And there's so much more of the growth curve left ahead of us. There were 25 million new mobile banking customers last year. Despite this, if you look at the number of financial institutions offering mobile banking, 16% said, yeah, we'll probably get around to that in the next year or two. I'm not so sure. We've got some other stuff we want to work on, but we're watching it, believe me, and we might very well get to that. And another 6% said, no, that's not for us. We don't see any need at all for our customers to be able to engage through us through the pocket that more than 3/4 of them carry, the device that they carry in their pocket every day. So recap and leave you with a couple of closing thoughts here, and then I'm happy to take question and answer. The first thing, what do we have to do to avoid our Kodak moment? Well, focus on the customer and truly from their perspective, the customer experience, not just providing service as we define it. Mind the gap, that customer experience gap of really deeply understanding how our customers want to engage and being able to provide that. And lastly, creating an environment where we can really embrace and adopt new ideas. It's not just embrace, yep, okay, that's a new idea, that's cool. We have to really be able to put them into place if we're going to be able to catch this opportunity and avoid the threat that's happening in this new era. Because good ideas are everywhere, but the value is putting them into action. And the last thought I'll leave you with here today is the best way to predict the future is to create it. So with that, I'll thank you very much, and Eric, I'm happy to take any questions that we might have.
That was great. I had lots of questions jump into my head as you were talking, and I was resisting breaking your stride because it was just flowing so nicely. So
thank you.
All very, very good stuff. So as a reminder, if you've got a question or a comment that you'd like to share, please feel free to use the chat function in your control panel and toss it in there, and I'll go ahead and ask that for you. The one question that I get oftentimes when I talk to banks about fintech and innovation and kind of some of these other companies that are at risk of eating our lunch as community bankers is, and I'm sure you've heard it too, well, we're with insert main data center here, we're with so-and-so, and our online banking is controlled by them. Our mobile banking app is controlled by them. Our person-to-person payment capability is controlled by them. And until insert data center here offers these cool new innovative things like Venmo or Uber-like experience or sophisticated data analytics with predictive profiling, we really can't do anything. And I'm curious, how true is that statement? And the second part is, are there opportunities for a progressive-minded community bank to leverage some of these fintech companies, and instead of seeing them as the enemy or a threat, is there a way to work collaboratively with them to realize it's better to do business with them than to fight it and offer those services, because at some point their customers are going to use them?
Yeah, so I think there's kind of two questions embedded. I'll take the second one first, which is, should we partner with these? And the short answer for me is yes, probably. I mean, obviously it depends on, your bank, your situation, what are you trying to accomplish, which partner. But in general, I just came back from Finovate last week in London. It's a 3-time-a-year show, East Coast, West Coast, in London. Of Fintech, back-to-back demos, 72 companies over 3 days. I think this is the 14th show I've attended in the past few years. And I've definitely noticed a trend where it used to be a lot of fintechs would demo and talk about how they're going to put banks out of business, and because the whole industry sucks. You look at Simple, was one of the examples we had up there. They famously started an email between Josh Reich and Shamir Kirkle, the founders, that said, hey, what if we started a bank that didn't suck? That was their mission statement, because they just felt like the whole experience was just horrible. Well, ironically, as they built that up, they were acquired by a bank. They're now a part of BBVA. They were acquired for $117 million about a year and a half ago. So, you do see banks making these acquisitions, but most of the companies now are not trying to go direct to consumer. They're trying to create something that they want to sell to a bank. They want to partner with a bank and being able to put a better customer experience layer on top of the core that you already have. And the first part of your question is, well, can they do that with their current core providers? And again, the ultimate answer is it depends. But I know folks at FIS and at Fiserv and at Q2 and at Jack Henry, and I see them at shows like Finovate, and they're acquiring a lot of these companies and putting those capabilities in place. Now, is the roadmap match up with the exact capability you want today versus their ability to deliver it to you? It may not. But I think in general, the core providers know that. And where we're ultimately heading is into much more of a Lego type environment. APIs, application programming interfaces, are really the little switches that allow different kinds of apps to talk to each other, and through a common translator. And we're starting to see more and more of that, where more of the bank systems are being built with an API layer so that you can plug other kinds of things on top. And so I think that you may not have the ability to do everything you want to do today, but in general, there are a lot of options available out there. And I think it's really incumbent upon the senior leadership of banks to really take a step back and think about what kind of experience they want to provide and look at the options. There's a pretty good chance that there's an option for you to provide something better than you have today, even though it may not be as easy as push a button and be done with it.
Good. It's reassuring to hear the names of the data centers that you rattled off, the core service providers, being present. Because I can tell you, when I was a banker and we launched online banking, having a password that was more than 6 characters long was a challenge for me,
right,
just from a security perspective. And heaven forbid you ask them to do some sort of suggestive profiling in online banking based off of customer profiles, because you have that data, but you can't use it. It was locked away, kept secret, and unusable. So it's good to hear that the tides might be shifting a little bit.
Well, and those companies are, they've got their own slate of competitors now too, right? The complaint you described is not a wrong or an unusual one, and there are other companies who've sought to disrupt them. So there are other alternatives available too.
Yeah. Well, you had mentioned Lending Club, and I think I read a press release that goes back as far as 2013, where community banks actually had started participating in Lending Club, quote unquote, buying loans through the marketplace.
Yep.
It doesn't happen a lot, and I think I hear a lot of banks say, "Oh, we can't do Lending Club because regulations don't allow it." I heard that argument when ING was opening accounts online as a federally regulated thrift, which is what I was, and they were opening accounts without having to have you come to a branch office, and our compliance department said, "We can't do that. Regulations don't allow it." And so maybe talk a little bit about the role of compliance and regulation in all of this, because I know the last several years that's been an area that a lot of the CEOs that I speak with have been afraid to upset just because of the threat of kind of regulatory backlash for examiners. How big of a factor is that really for a community bank?
Sure. And I spent 20 years inside the banking industry, most of that at the same institution that started at $6 billion, and when I left, we were $400 billion. So I get this, and I love to joke about the business prevention department, but that's not to say I don't understand why we have a compliance department and legal department and all of that kind of stuff. But I also think that many times we get in our own way, and we come up with our own interpretations of regulations, and then those become policies and procedures, and then we audit people against those policies and procedures, not having a real conversation with the regulators and saying, look, we understand the letter and the spirit of this law or regulation, and but it's getting in the way of our customer experience, and we propose doing it this way, that way. And another kind of question embedded in the compliance conversation, the regulation conversation, is, just wait till the regulators catch up to some of these fintechs. We need a level playing field. Well, I'm never going to argue against a level playing field, but if you think that the answer is just to make sure we strap down the fintechs and bring them down to equally archaic terms. A, that's not going to happen, and B, God, we should hope for something much better than that. If somebody has figured out a way to stay compliant and not be so onerous on our customers, I think we should embrace that and try to figure out a way to do it. So many of those fintech customers are talking directly to regulators. I know that the CFPB has reached out directly to me, as had the White House. And so I know that they're having conversations and trying to improve the process. Well, I made it through the whole thing without a sneeze or sniffle, and there you go. So excuse me.
you just put an enthusiastic end to a great presentation, I guess.
Thank you.
So you obviously have your Twitter handle up there, and I know you're active on Twitter, and I get a lot of great article suggestions and a lot of good information from you also on LinkedIn. Are those a couple of the best ways to engage if somebody wants to follow up with you and talk further?
Yep, so you can find me on my website in the lower right-hand corner of the screen, jpnichols.com. I've got contact information there. My Twitter handle is @jpnichols, and I'm happy to connect on LinkedIn. Though if we hadn't had a chance to meet face-to-face yet, just drop me a note. Tell me that you heard me here in this webinar and you'd like to connect, and I'd be happy to do so.
Cool. Good deal. Well, in the last 3 minutes that we have, because I like to squeeze every bit of the 60-minute time that we've reserved, any closing thoughts or recommendations from you, old technology bank innovation sage? And I said old, not old.
Yeah, well, both apply. And, I think that, Eric, maybe the most important thing is, technology is a driver of some of the changes that we're seeing, but it's just a tool. And I think people confuse innovation and technology, and even though they're related terms, being innovative doesn't necessarily mean we've got the latest, greatest, hottest thing that's on the top of the hype curve. It just really means we're moving forward to put new ideas in place, and whether those are ideas to improve our operating efficiency, or improve the customer experience, or launch new products and services. I think everybody has to embrace innovation, and technology is really just a tool to help us do that. At the end of the day, some aspects of our businesses never change. We got to take great care of our clients. We need to gather deposits. We need to make loans. We need to sell fee-based services, and we need to not make dumb mistakes. We have to manage our risk. Those 5 things have always been there. They'll never go away. And not to really fear technology as this new thing. It's really just a tool to help us accomplish one or more of those goals.
Awesome. Well, that's good. You did not disappoint, my friend. I knew this was going to be a great session, and like I said, I've got a boatload of notes here and probably a handful of things I want to call you right back on and talk about. So hopefully everybody that was able to be part of the webinar today live got a lot of good information, and if you're listening to this on a replay, hopefully you enjoyed it, and hopefully you'll come back for a future Banker Education Series webinar and experience another great guest. But I want to thank you for your time today, JP, and being our expert on FinTech, and I wish you the best, and I look forward to chatting soon, and hopefully we'll get a chance to see you in Seattle this summer.
Great. Thanks for having me.
Sounds good. Thanks, everybody, and have a great week. Bye-bye.